In this video, we are going to talk about should you invest in S&P 500 index or real estate. So before starting, please like this video and subscribe to this channel for our future updates. What is the S&P 500 index? The S&P 500 index, also known as the Standard & Poor's 500 index, is a stock market index that tracks the performance of 500 large-cap stocks traded on the New York Stock Exchange, NYSE, and the NASDAQ. The index is considered a benchmark for the overall performance of the U.S. stock market and is widely used by professional investors, financial analysts, and economists as a measure of the U.S. stock market's performance. The S&P 500 index is composed of stocks from a wide range of industries, including technology, finance, healthcare, and consumer goods. The index is weighted by market capitalization, meaning that the larger a company's market capitalization, the greater its weighting in the index. This means that the index is heavily influenced by the performance of the largest companies in the U.S. stock market. The S&P 500 index is maintained by S&P Dow Jones Indices, a joint venture between S&P Global and Dow Jones & Company. The index is widely followed and considered to be one of the most important stock market indices in the world. What is real estate? Real estate refers to the buying, selling, and renting of land, buildings, and other properties. It encompasses the physical and legal aspects of owning and using land, including residential and commercial properties, as well as industrial and agricultural land. The term real estate is often used to refer specifically to the physical properties themselves, while the broader field of real estate includes the professionals, such as real estate agents and brokers, who help facilitate transactions. Has real estate or S&P performed better historically? It is difficult to make a direct comparison between the performance of real estate and the S&P 500 index, as they are two different types of investments with different characteristics and risk profiles. Historically, the S&P 500 index has tended to generate higher returns over the long term than real estate. The S&P 500 index is considered a benchmark for the overall performance of the U.S. stock market and has returned an average of around 10% per year since it was first established in 1926. However, it is worth noting that the S&P 500 index is composed of large-cap stocks, and the stock market as a whole has been known to be highly volatile. On the other hand, the performance of real estate can vary greatly depending on a number of factors, such as location, property type, and economic conditions. According to the National Council of Real Estate Investment Fiduciaries, NCREIF, the total return for the NCREIF Property Index, which tracks the performance of commercial real estate investments, was 10.4% for the year ending 2019. However, it should be kept in mind that this is an average return, and the performance varies greatly by location and property type. It's worth noting that the stock market and real estate market have different characteristics and have different risk profiles, and it's not a direct comparison. Both have the potential to generate significant returns, but both also come with their own set of risks. Returns: S&P 500 versus housing market. Consider the 47 years from 1975 to 2023. A $100 investment in the average home, as measured by the Federal Housing Finance Agency's Home Price Index, in the fourth quarter of 1975 would have increased to almost $928 by the last quarter of 2022. If all dividends were reinvested, a similar $100 investment in the S&P 500 in 1975 would produce nearly $19,351 in 2022. Key differences: while both stock and property prices represent an asset's market value, they should not be compared solely on market returns. For one thing, equities have historically been more volatile than real estate, which means that bigger gains may come with higher risk. Stocks are ownership stakes in a publicly traded corporation. They are not physical assets and have no use other than to function as a store of wealth and a liquid security instrument. While there is some reason to expect that the aggregate stock market will increase in real value over time, there is less reason to believe that a single stock will increase in perpetuity. Real estate is not the same as equities. While some people speculate on real estate values, commercial and residential real estate serve practical purposes. People reside in single-family homes and condominiums. Commercial property is where businesses are located. Physical property has monetary value. This results in two opposing phenomena. On the one hand, existing real estate structures should depreciate in value over time due to wear and tear. An unmodified home has no incentive to appreciate in value over time. All of the floors, ceilings, appliances, and insulation deteriorate and lose value. What happens to the housing market when the stock market crashes? Depending on the magnitude of the disaster, the effects of a stock market crash on the housing market can be mixed. Falling shares can bring more money into the real estate market in some situations, as investors shift to less risky assets. As incomes decline and banks grow more hesitant about lending, a prolonged downturn is more likely to harm real estate prices. How do you invest in the real estate market? Buying a property is the most basic way to participate in the real estate market, albeit this represents a significant financial commitment for the average retail investor. You can also invest through a real estate mutual fund, or REIT. These are funds that invest in a rental property portfolio and distribute the net income to their owners. This offers the extra benefit of diversifying the portfolio. What are the benefits of investing in real estate? Real estate outperforms the stock market in terms of risk-adjusted returns. Although property values do not rise as swiftly as stock prices, there is a smaller risk of an investor losing their savings in a sudden real estate crisis. However, as the 2008 Great Recession proved, home disasters remain a risk. Should I invest $500,000 in real estate or S&P 500? You're already in an excellent position if you have $500,000 to invest. According to the wealth management platform Personal Capital, the average 20-something has only $10,711 invested. Meanwhile, the average 60-something user has more than $210,900 invested. Still, that's a lot less than $500,000. According to the Pew Research Center, only 14% of American families have direct stock investments. Nonetheless, slightly more than half, 52%, have stock market investments, the majority of which are retirement accounts such as 401ks. You may get a lot of bang for your money in real estate because it has annual returns of 3 to 4%. However, given the S&P 500's average yearly return of 10%, putting $500,000 in an investing account can eventually grow into millions by the time you retire, even if you never add another dime. Rent costs, property taxes, neighborhood vibes, the local job market, school accessibility, future development plans or lack thereof, natural disasters such as flood zones, and other criteria are frequently used to determine whether real estate properties are excellent or bad investments. However, investing in ETFs and mutual funds can help you diversify your portfolio and reduce the risks associated. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.